All right, deep divers, buckle up. Today, we're diving headfirst into a topic that might sound a little dry taxes, but trust me, it's absolutely packed with surprising opportunities and real-world impacts, especially if you're part of a business with multiple owners.
Indeed. We're cutting through the jargon today, yeah. We're going to explore the heart of U.S. partnership tax return.
Form 1065.
That's the one, Form 1065, and its essential sidekick, Schedule K-1. Our mission, really, is to transform these forms from maybe daunting documents into powerful tools,
Okay.
showing you not just what they are, but how they can unlock significant tax efficiencies and help you steer clear of common financial potholes.
Okay, let's unpack this then. We've received a fascinating stack of material directly from the official IRS instructions for Form 1065. It's dense, no doubt about it. But our goal is to extract those gleaming nuggets of knowledge, right? Turn you into a well-informed partner.
Yeah, someone who gets it.
Someone who truly understands their business's tax landscape and can spot opportunities for smarter financial decisions. Think of this as your shortcut, maybe, to understanding a crucial part of your business's financial DNA.
Good way to put it.
So let's start at the very beginning. Yeah. When the IRS uses the word partnership, what exactly does that mean for tax purposes? It's not always as straightforward as just shaking hands on a deal, is it?
No, it isn't.
Like, are there hidden traps? Could someone accidentally find themselves in a partnership for tax purposes without even realizing it?
That's a great opening question, actually, because you've hit on a common misconception. Fundamentally, for tax purposes, a partnership is defined as, well, a relationship.
Okay.
Where two or more individuals or entities join forces.
Yep.
They're carrying on a trade or business, and the key is they intend to share profits and losses.
Right.
And each person brings something to the table. Could be cash, property, their labor, maybe unique skills.
Makes sense.
And here's the kicker, as you said. This definition holds true even if there's no formal written agreement.
Wow, okay.
The IRS looks at the substance of your activities. Yeah. So, yes, you could absolutely find yourself in an unintentional partnership if you and, say, another person are running a business together, sharing income and expenses, even without formal paperwork.
That's huge.
It's a crucial point to understand from day one.
That's really important for anyone collaborating on a venture then. So beyond what we traditionally think of as, two people in a partnership, what other kinds of entities does the IRS sweep under this partnership umbrella?
Well, the term partnership is surprisingly broad in tax law. It includes everything from traditional limited partnerships to things like syndicates, groups, pools, joint ventures, or, pretty much any other unincorporated organization that's conducting a business or financial operation.
So it's quite wide.
It is. What's explicitly excluded are entities already classified as corporations, trusts, estates, or sole proprietorships.
Yeah.
That distinction is paramount because it dictates which tax forms you'll file and, more importantly, how your business income and losses will be treated.
Right, at both the business level and your personal level.
Exactly, both levels.
And a big one that often brings up questions is the limited liability company, or LLC. So many small businesses choose an LLC for the legal protection it offers. How do LLCs typically fit into this tax puzzle? Or can they choose a different path?
Yeah, LLCs are incredibly flexible, which is why they're so popular, right? While they provide that limited liability under state law, protecting your personal assets from business debts for federal income tax purposes, they're often classified as partnerships by default.
By default?
Yes, if they have two or more members and don't explicitly elect otherwise. This means a multi-member LLC will, by default, have the same filing requirements as a domestic partnership.
Which includes filing Form 2065.
Which includes filing Form 1065. Here's where the strategic superpower comes in. An LLC can actually elect to be taxed differently.
Ah, okay.
With Form 8832, an LLC can choose to be treated as a corporation, either a C Corp or an S Corp, for tax purposes.
So they have a choice.
They have a choice. This flexibility is a significant strategic advantage. It lets business owners kind of mold their tax identity to suit their specific goals. Maybe a simple pass-through for a startup or a corporate structure if they need to attract serious investors later on.
All without changing the underlying legal entity?
Exactly. That's true agility in action. It allows you to pick the tax classification that truly aligns with your financial and growth objectives.
That makes perfect sense. Now, within this broad definition of a partnership, are there different types of partners the IRS recognizes? Because their roles and their exposure to risk can vary so much.
Absolutely.
Right.
The IRS instructions distinguish between a general partnership, which, well, as the name suggests, is composed only of general partners,
Right.
and other structures that include limited partners. A limited partner, on the other hand, is generally someone in a partnership formed under state law whose personal liability for partnership debts is restricted.
Limited to what they put in, basically.
Pretty much. Limited to the amount of money or property they've contributed or are obligated to contribute. It's worth noting, too, that even certain LLC members or business trusts can sometimes be treated as limited partners for specific tax purposes.
And that matters because...
Well, it can affect things like their self-employment tax obligations. So understanding these distinctions is really key because it shapes both legal liability and tax treatment.
Okay, so their actual role in the legal structure influence their tax picture. What about specific scenarios, like, say, spouses who own a rental real estate business together? Is there a special election that simplifies things for them?
Yes, there is. And it's a very practical provision called the Qualified Joint Venture Election, or QJV.
QJV.
This is a fantastic example of a simplification strategy, really designed for married couples. If you and your spouse are the only members of a jointly owned and operated rental real estate business,
Just the two of you.
just the two of you, you can elect for each of you to report your share of income and deductions on separate Schedule E forms.
Schedule E on your personal 1040.
Exactly. Which are part of your individual Form 1040. This effectively bypasses the need to file a more complex Form 1065 partnership return.
That sounds much simpler.
It is. Now, while it significantly simplifies the reporting, it's important to understand electing QJV status doesn't change the underlying application of, say, self-employment tax rules or the passive loss limitation rules.
Okay. It's just about the filing mechanism.
Precisely. It's purely a streamlined way to report your shared business activity directly on your personal returns. Saves you time, potentially professional fees, by avoiding a separate partnership return. It's a great example where careful planning can simplify your tax life.
Okay, this is where it gets really interesting and honestly often a little confusing for new partners. Unlike corporations, partnerships generally don't pay income tax themselves.
Correct.
So if the business isn't taxed directly, who is? And how does that work for the partners?
That's the fundamental shift, right? And it leads us directly to the flow-through principle. This is the cornerstone of partnership taxation. And it's why understanding Form 1065 is so crucial for your personal tax situation. The partnership entity itself, it's generally not subject to income tax.
Okay.
Instead, all of its income, gains, losses, deductions, credits, they all flow through directly to the individual partners.
Just pass right through.
Pass right through. Each partner then reports their specific share of these items on their own personal tax returns, whether that's a Form 1040 for an individual or, another entity's return if the partner is a corporation or something.
And the big advantage there is avoiding that double taxation.
Exactly. That's the power of it. You avoid double taxation where, a C-Corp's profits get taxed at the corporate level and then taxed again when dividends are paid out.
Right.
With a partnership, the income is taxed only once, directly to the partners. This makes understanding your Schedule K-1 absolutely vital. Every figure on it directly impacts your personal tax burden.
And offers potential for planning.
Absolutely. It offers various avenues for strategic tax planning. It's a direct link to your personal financial well-being.
So we've established what a partnership is for tax purposes, why that crucial flow-through principle matters. Now let's get into the nitty-gritty. Navigating the actual filing process. The IRS has been making a big push for electronic filing, haven't they?
They have a very big push.
What are the current requirements there, especially for partnerships?
That's right. Electronic filing, or ELU filing, is rapidly becoming the standard. Starting January 1, 2024, partnerships are now generally required to e-file Form 1065 and all related forms and schedules if they file. Get this. 10 or more returns of any type during the tax year.
Any type, so not just the 1065 itself.
Correct. This isn't just limited to income tax returns. It includes information returns, employment returns, excise tax returns.
Like W-2s, 1099s.
Exactly. W-2s, 1099s, payroll tax forms. If your total count across all types hits 10 or more, e-filing for Form 1065 is mandatory. Yeah. Plus, there's another threshold. Partnerships with more than 100 partners are also required to e-file, regardless of how many other types of returns they file.
So large partnerships always e-file.
Basically, yes. It really emphasizes the IRS's push for digital efficiency.
That's a pretty broad requirement, could affect many businesses. But what if a partnership genuinely faces a situation where they just can't meet that electronic filing mandate? Is there any kind of exception? A way to get a waiver?
Yes, there is. Thankfully. The IRS understands that sometimes, unforeseen circumstances or genuine hardship can make mandatory e-filing impossible.
Like what kind of hardship?
Well, the instructions don't list specifics, but you can imagine things like perhaps lack of reliable internet access in a very remote area, or maybe a sudden natural disaster affecting records. In such cases, a partnership can submit a written request for a hardship waiver.
Where do they send that?
These requests are processed by the Ogden Submission Processing Center. You'd need to follow their specific guidelines for making that request, explaining the hardship. It's like an emergency escape hatch for genuine, unavoidable situations.
Good to know there's a safety valve. Okay, so once you're ready to file either electronically or maybe on paper with a waiver, what are the timelines? And who exactly needs to sign these forms to make them valid in the IRS's eyes?
Right, timelines. The IRS has some practical flexibility if the current year's forms aren't available by the filing deadline.
Which happens sometimes early in the year.
It does. A partnership can use a prior year's Form 1065. However, you absolutely must clearly indicate the correct tax year you're filing for, and crucially, make sure to account for any new tax law changes effective for that later year.
Okay, that makes sense. And the signature?
The signature is critical. Form 1065 is not considered valid unless it's signed by a partner or an LLC member.
Not just anyone at the company.
No, it must be someone with the authority of a partner or member. If a receiver, trustee, or assignee prepares a return, they must sign it and include a copy of the court order granting them that authority.
Okay.
And if you're filing an amended adjustment request, an AAR, the partnership representative for the reviewed year, or their designated individual, is the one who has to sign.
And what if a business uses a paid tax preparer? What are their specific responsibilities in this process?
The paid preparer. They have very specific legal obligations. They must sign the return in the designated paid preparer use only area.
Right at the bottom, usually.
Yep. They have to accurately fill in all the required information and, critically, use their preparer tax identification number, or PTIN.
Not their social security number.
Absolutely not their SSN. They use their PTIN. They're also legally required to give the partnership a completed copy of the return for their records, in addition to the copy filed with the IRS.
That ensures accountability?
And provides the partnership with complete documentation.
Okay, so once it's all prepared, signed, where does this completed Form 1065 actually go? Does everyone send it to the same place, or are there different mailing addresses if you're filing on paper?
That's a common question, and no, it's not a single address. The specific IRS Service Center mailing address for Form 1065 actually depends on two key factors.
What are they?
The partnership's principal business location, so where it's based, and significantly, its total assets at the end of the tax year.
So size matters here.
Size matters.
Okay.
For example, a smaller partnership in, say, New York or Illinois with less than $10 million in assets might send the return to Kansas City, Missouri.
Okay.
However, if that same partnership had $10 million or more in assets, or if they were required to file Schedule M3.
The complex reconciliation schedule.
Right. They would send it to Ogden, Utah. There are different addresses based on geography and business size. You always need to check the current year's Form 1065 instructions for the precise address that applies to your partnership.
Getting it right avoids delays.
Exactly. Ensures your return reaches the correct processing center without delay.
What about using private delivery services? Like FedEx or UPS. Can you use those to make sure your return gets there on time? Or is it only the good old U.S. Postal Service?
You absolutely can use designated private delivery services, or PDSs. The IRS publishes a list of these approved services on irs.gov PDS.
Okay, so check the list first.
Definitely check the list. Using an approved PDS qualifies your filing for the timely mailing as timely filing paying rule. This is a big advantage because it provides official written proof of the date you mailed your return.
Which can be critical for deadlines.
Critical for meeting deadlines and avoiding penalties. However, there's one important limitation you need to know.
What's that?
PDSs cannot deliver to P.O. boxes. So if the correct IRS mailing address for your return happens to be a P.O. box,
which some of them are,
you must use the U.S. Postal Service. So always double-check the address format before choosing your delivery method.
That's a very helpful distinction to remember. Now, sometimes, despite all best efforts, careful preparation, people run into problems with the IRS. Issues they just can't seem to solve on their own. Is there a safety net? Someone who can advocate for taxpayers in those difficult situations?
Absolutely. And this is a critical resource that, honestly, many taxpayers don't fully utilize. It's called the Taxpayer Advocate Service, or TAS. TS. It's an independent organization operating within the IRS itself.
Independent within the IRS. How does that work?
Well, it was uniquely established by Congress, specifically to help taxpayers resolve problems with the IRS. They essentially act as your voice at the IRS.
Okay.
Ensuring fairness, protecting taxpayer rights under the Taxpayer Bill of Rights, and helping you navigate complex issues when you've basically hit a roadblock with the traditional IRS channels.
That sounds like an invaluable resource, especially when things feel overwhelming. What kind of situations would TS typically step in to help with?
TS can help in a wide range of scenarios. For instance, if an IRS problem is causing you significant financial hardship.
Like you can't pay bills.
Exactly. Maybe you can't pay your rent or afford food because of a tax issue. They can also assist if you've already tried and failed to resolve your issue through regular IRS channels.
You've called, you've written, nothing's working.
Right. Or if you believe an IRS system, process, or procedure just isn't functioning as it should, and it's causing you undue burden, their services are completely free. Completely free. And they assist all types of taxpayers, individuals, businesses, even exempt organizations.
So using TAS, that could actually be a way to, well, save money or prevent further financial harm.
Absolutely. Utilizing TAS can be an incredibly effective strategy for protecting your financial well-being and preventing further complications. By resolving disputes efficiently and ensuring your rights are upheld, they can save you significant time, stress, and potential penalties, which is effectively a major form of tax savings, right?
Yeah, avoiding penalties is definitely saving money.
Think of them as your dedicated problem solvers when you feel stuck. You can learn more and find assistance on their website at taxpayeradvocate.irs.gov or call them toll-free at 877-777-4778.
Okay, 877-777-4778.
Good to know. Let's get into the absolute heart of partnership tax reporting now. Form 1065 itself and its indispensable partner, Schedule K-1. What exactly is the purpose of these two forms? How do they work together? Think of it this way. Schedule K is the partnership's comprehensive internal summary, almost like a master ledger for tax purposes.
The big picture.
The big picture, exactly. It's where the partnership aggregates and tallies up all the partners' shares of the business's overall income, credits, deductions, and other essential items. It's particularly important because certain types of income, like rental activity income or portfolio income, think dividends and interest.
They aren't on page 1 of the 1065.
Correct. They aren't reported on the main page of Form 1065. They're meticulously summarized here on Schedule K. This provides a holistic, detailed view of the partnership's complete financial activity from a tax perspective.
So Schedule K is the partnership's blueprint. What about Schedule K1 then? How does that individualize the information for each partner?
Schedule K1 is where the rubber meets the road for each individual partner. It's an individualized report. It breaks down your specific share of that summarized income, credits, and deductions that were tallied on Schedule K.
My slice of the pie.
Your slice of the pie, precisely. This is the crucial document the partnership must provide to each partner, usually by March 15th for calendar year partnerships.
So I can do my own taxes.
Exactly. So you can use it to prepare your own personal tax return, and a copy of every Schedule K-1 is also attached to the Form 1065 that's filed with the IRS. This is precisely how that flow-through principle is executed.
The link.
Each partner uses their K-1 to directly report their share of the partnership's financial activities on their own personal tax return. This also applies if a partnership interest is held by a nominee, or if the partner is a disregarded entity. The K-1 must ultimately get to the actual beneficial owner who reports the income.
Got it. So K is the summary. K1 is my personalized tax statement. What kind of basic identifying info do these forms require for the partnership itself and for each partner?
Okay, for the partnership, the top part of Form 1065 and Schedule K-1 needs the essentials: legal name, physical address, and the correct employer identification number, EIN.
The EIN is key.
Absolutely key. If the partnership doesn't have an EIN yet, they must apply for one. Usually online, it's pretty quick.
Do they need to know their tax classification first? Like if an LLC wants to be a corporation?
Yes, good point. For an LLC, it's vital to have already determined its federal tax entity classification partnership, corporation, or disregarded entity before applying for the EIN. That choice dictates the application process.
What if they applied but haven't received it by the due date?
Then they just enter applied for and the date they applied on the return. Accuracy here is foundational for compliance.
And for the partners themselves, what identifying information is needed there? Because that's critical for the IRS to connect the dots to my personal return, right?
Absolutely. For individual partners, their Social Security number, SSN, or Individual Taxpayer Identification Number, ITIN, is mandatory. For other entity partners, like a corporation or another partnership that's a partner, their EIN is required.
Any special cases, like an IRA?
Yeah, special rules for IRAs. You use the identifying number of the custodian of the IRA, not the individual beneficiary. And foreign partners who don't have a U.S. identifying number, the partnership needs to proactively tell them how to get one.
Okay. And I heard something about privacy, truncating the numbers.
Right. Here's a crucial detail for both privacy and compliance. Partnerships can truncate a partner's identifying number, like showing only the last 4 digits of an SSN on the Schedule K-1 copy sent to the partner.
Okay, my copy can be shortened.
Your copy can.
Yeah.
But truncation is absolutely not allowed on the Schedule K-1 that's filed with the IRS. The IRS needs the full number to link the income correctly.
Makes sense. What about disregarded entities? Like a single-member LLC owned by a partner?
Good question. If a partner is a single-member LLC or a trust treated as a disregarded entity, the partnership must use the Taxpayer Identification Number, TIN, of the beneficial owner of that disregarded entity.
So the real person or entity behind it.
Exactly. Ensures transparency to the ultimate taxpayer.
Beyond basic identification, are there financial thresholds? Situations where a partnership size might trigger additional, more complex reporting.
Yes, definitely. There are important benchmarks that signal the size and complexity of a business to the IRS. If the partnership's total assets at the end of the tax year are $10 million or more.
Okay, $10 million in assets.
Or if its total receipts for the tax year are $35 million or more.
$35 million in receipts.
Right. Either of those generally triggers additional, more detailed reporting requirements, specifically the need to file Schedule M3.
Which we mentioned briefly. What is that again?
Schedule M3 provides a reconciliation of the partnership's net income or loss for financial accounting purposes, like what's on their books with the income or loss calculated for tax purposes.
Bridging the book tax gap.
Precisely. These thresholds are a signal to the IRS that they need a deeper dive into the partnership's financial statements and tax adjustments. More scrutiny, basically.
Now for the real nitty-gritty, the income and deductions. This is where strategic tax planning truly comes into play, isn't it? What's the main idea behind reporting trade or business income and deductions on the main part of Form 1065?
The primary goal on page 1 of Form 1065 is to report the partnership's core trade or business income or loss. That's the main operating activity.
Just the main business.
Just the main business. It's absolutely critical to remember this section does not include things like passive rental activity income or investment income, which we call portfolio income.
Where do those go again?
Those are handled separately on Schedule K and then flow to the K-1s. The partnership must also ensure that any items requiring separate computations by individual partners, like charitable contributions, foreign taxes paid, certain investment expenses, are excluded from this main section.
Why excluded?
Because those items are broken out specifically and reported directly on Schedule K-1 to each partner. Each partner needs to make their own individual determinations on how those specific items impact their personal tax return, based on their unique tax situation, their other income sources, limitations, etc.
So the 1065 page 1 gives the partnership's business operating result, and the K1 gives the partner all the pieces they need for their own return.
Exactly. It's all about providing the right building blocks for each partner's final tax picture.
So when it comes to the business deductions on this main section, what are some common ones? And are there nuances or, smart strategies that could really affect a partner's tax picture?
Okay, deductions. Only deductions directly related to the trade or business activity are reported here on lines 9 through 21 of Form 1065. Expenses related to rental activities, deductions linked to portfolio income, or general non-deductible expenses are always reported elsewhere, usually Schedule K or K-1.
Got it. So what are some key ones on page 1?
Let's look at some key deductions and their strategic implications. First, salaries and wages, line 9. Pretty straightforward compensation paid to employees. But remember, it excludes amounts already in cost of goods sold or elective contributions to employee 401ks, SEPs, or simple IRAs. Those are handled differently.
Okay. Then there's line 10, guaranteed payments. This one's a bit different, right? Payments to partners aren't like paying an employee, are they? How do guaranteed payments work? Can they be used for tax savings?
They certainly operate under distinct rules. Guaranteed payments are amounts paid or credited to a partner for services they perform for the partnership. or for the use of their capital,
Okay.
where these payments are determined without regard to the partnership's income. Unlike a share of profits, these payments are typically fixed or determined by a formula. They are generally deductible by the partnership on line 10.
So the partnership gets a deduction. How does that help the partner or save taxes overall?
Right. Here's where a key tax-saving opportunity comes in. This line crucially includes amounts paid during the tax year for insurance that constitutes medical care for a partner, their spouse, their dependents, or their children under age 27.
Partner health insurance premiums.
Exactly. By classifying a partner's medical care insurance premiums as a guaranteed payment, the partnership can deduct it. And the partner generally isn't taxed on it as income, provided they don't have access to other employer-sponsored health insurance.
So it makes the premiums deductible for the partner effectively.
Yes, it effectively allows partners to deduct their health insurance premiums above the line on their personal return, reducing their adjusted gross income and overall tax burden. It's a powerful way to structure partner compensation to maximize benefits for both the partnership and the individual. Significant savings potential there.
That's a practical, actionable benefit for partners. What about larger expenses, like investments in equipment or property? How does depreciation work there? Line 16. And are there ways to accelerate those deductions for immediate tax savings?
For depreciation, you're reporting only the depreciation on assets used in your trade or business activity. Now, a major tax-saving opportunity here is the Section 179 deduction.
Section 179, I hear about that a lot.
You should. Think of Section 179 as hitting the fast-forward button on your tax savings. Instead of slowly deducting the cost of new equipment or qualifying property over many years.
The standard depreciation schedule.
Right. You can elect to expense a significant portion or even the entire cost of that property in the very year it's acquired and placed in service. Immediately, up to certain dollar limits. This deduction is then passed through to the partners on Schedule K-1, subject to various limitations at both the partnership and partner levels. This isn't just about saving tax. It's about freeing up significant cash flow now.
Which businesses need.
Absolutely. For reinvestment, debt reduction, expansion, it's a game changer for businesses actively investing in their growth, providing an immediate boost to their bottom line.
So Section 179 is a big tax saver. What about other depreciation nuances? I see AMT mentioned.
Right. You also have to be aware of alternative minimum tax, AMT depreciation adjustments. This is a complex area, honestly. But the key takeaway for partners is that for AMT purposes, depreciation sometimes needs to be refigured.
Why?
Especially for real property like buildings. The depreciation method or life might be different for AMT. This can lead to a difference between your regular tax depreciation and your AMT depreciation, resulting in an adjustment reported on Schedule K-1.
So I don't need to calculate it, but I need to be aware of it on my K-1.
Exactly. You don't need to be an expert in the calculation, but it's a detail to flag for your tax advisor. It ensures you correctly calculate any potential AMT liability on your personal return.
And what about employee benefit programs on line 19? Is there a distinction between those deductions and what we just discussed about guaranteed payments for partners' medical care?
Yes, there's a clear distinction, and it's important for proper reporting.
Yeah.
Employee benefit programs, line 19, refer to the partnership's contributions to general employee benefits. Think health insurance for employees, welfare plans, other benefit programs that are not part of a pension or profit-sharing plan reported elsewhere.
So this is for the rank-and-file employees?
Generally, yes. You do not include amounts paid for a partner's medical care, for the partner, spouse, or dependents on this line. Those specific partner-related medical care expenses are, as we discussed, included on the guaranteed payments line, line 10.
Okay.
And then they're specifically broken out again on Schedule K and K-1 to the partners. This ensures they receive the proper tax treatment on their personal returns, like that above-the-line deduction we talked about. It's all about making sure the right deduction lands in the right place.
Ah, the classic business lunch. Line 20 covers other deductions, which often includes meals and travel. I bet a lot of our listeners are wondering how much of that is still a legitimate write-off, or if those expense reports are now just wishful thinking.
A very common and important question.
How much can businesses actually deduct these days for travel, meals, and entertainment? This is an area many businesses try to maximize for tax savings, right?
Right. For travel, meals, and entertainment, the rules have definitely shifted in recent years. Generally, non-entertainment meal expenses are still 50% deductible, provided they are ordinary and necessary for the business.
So 50% for a business meal where you actually talk business?
Correct. Your business lunches or dinners, where actual business is discussed, can still provide that 50% deduction. However, for entertainment expenses, think tickets to a sporting event, golf outings, concerts to schmooze clients.
The fun stuff.
The fun stuff. These are largely disallowed after recent tax law changes.
Yeah.
The era of deducting client entertainment is mostly over.
So no deduction for the baseball tickets, even if you take a client.
Generally, no deduction for the entertainment portion itself.
Yeah.
There are very specific rules for legitimate travel expenses, business gifts with dollar limits, and luxury water travel. You really need to check IRS Publication 463 for the details.
So understanding these rules precisely is key for tax savings.
Absolutely. It's crucial for legitimate tax saving through compliance. Knowing exactly what you can and cannot deduct prevents disallowed deductions, avoids potential penalties, and ensures your business maintains a strong, defensible tax position. It's about maximizing what's allowed, not what's wished for.
What about interest expenses on business loans? Are there any limitations there, line 13, or can businesses generally deduct all of it?
There is a business interest expense, BIE, limitation under Section 163J for tax years beginning after 2017. It can limit the amount of business interest you can deduct.
Okay, a limitation exists.
But there's a significant and very welcome exception. Small business taxpayers are generally exempt from this limitation.
And how small is small?
A small business taxpayer is defined as one that's not a tax shelter and meets the gross receipts test. That means having average annual gross receipts of $30 million or less for the 3 prior tax years.
30 million, that covers a lot of partnerships.
It covers a vast number of them. This exemption is a major relief, allowing many partnerships to fully deduct their business interest without complex calculations. That's a direct tax-saving benefit, avoiding a potentially significant limitation on a common business expense.
Any other broad categories of expenses or rules from that other deductions line 20 that are commonly overlooked or have specific rules partners should be aware of?
Yes, 2 more significant areas to flag briefly. First, the Uniform Capitalization Rules, or UNICAP, under Section 263A.
UNICAP. Sounds complicated.
It can be. These rules require certain production and resale costs to be capitalized into inventory or other assets rather than being immediately expensed.
So you don't deduct them right away?
Correct. It affects how inventory and other assets are valued on the balance sheet and ultimately when those costs are recognized as expenses, usually when the inventory is sold. It's complex, but crucial for businesses involved in manufacturing or significant inventory management. Certain small businesses are exempt from UNICAP too, based on gross receipts.
Okay, and the second area?
Second, there are special rules for transactions between related taxpayers. For an accrual basis partnership, one that records expenses when incurred, not when paid.
Right.
Business expenses and interest owed to a related party, including any partner, can only be deducted in the tax year of the partnership that includes the day the payment is actually includable in the income of that related party.
Okay. Why that rule?
It prevents timing games. For example, an accrual partnership deducting an expense owed to a cash basis partner long before the partner actually receives the cash and has to report the income. This rule ensures consistent timing between the deduction and the income inclusion for related parties. It's a compliance focus for the IRS.
Okay, so we've gone through the main income and deduction lines on Form 1065. But partnership taxation isn't always straightforward, especially when we talk about how certain activities are treated at the partner level. Let's delve into passive activity limitations. This is where the nuances of tax efficiency really come into play, isn't it?
It absolutely is.
Because how you participate, or if you participate, can make a huge difference in how much loss you can actually deduct.
Yes, this is one of the most critical areas for partners to understand for maximizing tax efficiency. The passive activity limitations are designed to prevent taxpayers from offsetting, say, their salary or active business income with losses from activities where they aren't actively involved.
So you can't just use passive losses to wipe out other income easily?
Generally, no. The core rule is that activities where a partner doesn't materially participate are considered passive. This also applies, importantly, to all rental activities, regardless of the partner's level of participation, unless specific exceptions are met.
All rentals are passive by default?
By default, yes. And the crucial implication is that losses from passive activities can typically only be used to offset passive income, not your wages, not your active trade or business income.
So they get trapped.
They can get trapped, yes. This is why partnerships must report income, loss, and credits separately by activity type on the K-1, trade or business, rental real estate, other rental, and portfolio income. This allows the partner to apply the rules correctly.
That sounds like it could severely limit loss deductions for a lot of partners, especially in real estate. Are there exceptions to what's considered a passive activity? And how can understanding these exceptions lead to significant tax advantages?
Yes, and this is exactly where strategic tax planning becomes vital for unlocking potential deductions. Not all activities are passive, even if they might seem like it at first glance, for instance.
Trade or business activities in which the partner materially participated are not passive.
Material participation. How is that defined?
It's based on specific IRS tests. The most common is spending more than 500 hours in the activity during the year, but there are other tests too. Each partner determines their own material participation.
Rental real estate activities can be non-passive if the partner materially participated and met specific conditions, like qualifying as a real estate professional under the tax code.
Ah, the real estate professional exception. That's a big one.
Huge for people in the real estate business full-time. It allows them to potentially deduct rental losses against other income.
An interest in an oil or gas well operated under a working interest is generally not passive, regardless of participation, if the partner's liability isn't limited.
Okay, special rule for oil and gas.
Yes. And number 4, the rental of a dwelling unit used for significant personal purposes, like renting out your vacation home sometimes, is generally not treated as a passive activity. The rules get complex there depending on personal use days versus rental days.
An activity of trading personal property for the account of owners is also typically not passive.
So understanding these exceptions is a huge tax saver.
Potentially, yes, because it can change how your losses are treated. If an activity is non-passive, its losses might be deductible against your other non-passive income, directly improving your personal tax situation. It's crucial to identify these correctly.
That's a massive difference. But rental activity itself has some nuances. You said it's passive by default. How does the IRS define it, and what are the important exceptions that could turn a seemingly passive rental into something else for tax purposes, potentially opening up more deductions?
Right, so the general definition of a rental activity is one where the gross income primarily comes from payments for the use of tangible property. But there are several crucial exceptions to this general passive rule. Understanding these is a significant tax-saving strategy for property owners.
Okay, what are these exceptions?
Here are the main ones where a rental might not be passive.
If the average period of customer use for the property is 7 days or less, think short-term vacation rentals, like an Airbnb that turns over frequently.
So short-term rentals might not be passive.
Correct. They often fall out of the passive category under this rule.
If the average period of customer use is 30 days or less, and significant personal services are provided by or on behalf of the partnership.
What counts as significant personal services?
Think of a hotel. They provide daily cleaning, maybe room service, concierge services. Those are considered significant personal services that go beyond just providing the space. This makes the hotel more like an active business than a pure rental.
If extraordinary personal services are provided, where the customer's use of the property is really just incidental to the services they receive?
Like a hospital.
Exactly. You're paying for medical services. The room is incidental.
If the partnership customarily makes the property available during defined business hours for non-exclusive use by various customers, maybe like a golf course renting out carts hourly.
A guaranteed payment to a partner is never income from a rental activity.
So if my rental fits one of these exceptions, it's not passive.
Correct. An activity that qualifies for one of these exceptions is not automatically subject to passive loss limitations, potentially allowing partners to deduct losses more freely. Defining significant versus extraordinary personal services depends on facts and circumstances, frequency, value relative to rent, etc. It's a powerful area to explore with your tax pro if you have rental income or losses.
So if I understand correctly, sometimes income that looks passive can actually be treated as non-passive. Why does this happen? Does it benefit me or impact me as a partner?
That's exactly right. This is where recharacterization rules come into play. Think of it like this. The IRS doesn't want you playing games.
The games.
Yeah, making income look passive just so you can use up your passive losses that might otherwise be stuck. So for certain activities that appear passive but are maybe too easy to generate income from without substantial effort, the IRS has rules to recharacterize that income as non-passive.
Give me an example.
Okay, maybe net passive income from certain non-depreciable rental property activities, or income from passive equity finance lending activities. These can sometimes be recharacterized as non-passive.
So what does that mean for me? the partner?
Well, understanding this ensures proper reporting, first off, but it also means you might not be able to use certain passive losses against this recharacterized income. While it might sound like a limitation, it actually ensures proper reflection of your economic reality and prevents issues with the IRS. The partnership has to identify these activities on your Schedule K-1 so you can correctly apply the recharacterization rules on your personal return. It's about compliance.
Okay. Beyond passive activities, how does the partnership classify other types of income, specifically what the IRS calls portfolio income?
Right. Portfolio income is another distinct category that needs to be separately reported on Schedule K and K-1. Generally, it includes gross income from things like interest, dividends, royalties not derived in the ordinary course of business, income from REITs, real estate investment trusts, and gains from selling property held for investment.
Why is it separate?
It's crucial because it's treated differently from active business income or passive income, especially when it comes to limitations like the investment interest expense limitation.
Are there exceptions? When is interest or royalty income not portfolio income?
Yes, important exclusions exist. Income derived in the ordinary course of a trade or business is not portfolio income. So, if your business is a lending institution, the interest income from the loans it makes is active business income, not portfolio.
Yeah.
Similarly, if your business customarily offers credit to customers, the interest on accounts receivable is business income. Or if your business is in the trade of licensing intangible property, the royalties you receive are business income. This distinction affects how the income is treated for various limitations and ensures it's categorized appropriately based on the partnership's actual activities.
What are some other specific income, loss, and credit items that partners really need to be aware of from their K-1, especially those that might offer tax advantages?
Okay, you'll see several other important items, often with specific codes, on your K-1. For instance, net section 1.31 gain loss.
Section 1231. What's that?
It's from the sale of business property like machinery or buildings held over a year. This is a significant potential tax saving benefit. Why? Because if your partnership has a net section 1231 gain, it can be treated as a long-term capital gain on your return.
Which is taxed at lower rates.
Typically, yes, lower rates than ordinary income. And if it's a net section 1231 loss, it's generally treated as an ordinary loss, which can offset other ordinary income. So it's kind of the best of both worlds: capital gain treatment for gains, ordinary loss treatment for losses. Very favorable.
Nice. What else?
You'll also see casualty or theft gain loss reported separately depending on whether it's business or non-business property. There are also specific codes for Section 1256 contracts and straddles relating to complex financial instruments reported on Form 6781. If your partnership deals with those, your K-1 will have specific codes to discuss with your preparer. Also, cancellation of debt income, if applicable, would be reported. It's crucial for the partnership to accurately report all these items so you can handle them correctly on your personal return.
Finally, what about other crucial deductions and just general information that partners need to know, especially for staying compliant and avoiding serious issues?
Okay, a few other key items. Charitable contributions, both cash and non-cash, flow through on the K-1. A key point. For cash contributions of $250 or more, the partnership must get a written acknowledgement from the charity.
And provide that to the partners.
Well, they provide the information on the K-1, but the partnership keeps the actual acknowledgement in its records. The partner needs that info and potentially proof, if audited, to claim the deduction. You can't deduct it without proper substantiation. Small detail, but important for deductibility.
Makes sense. Anything really serious partners need to be aware of?
Yes. A very serious compliance consideration carrying significant risk if overlooked is the trust fund recovery penalty.
Trust fund recovery penalty. Sounds ominous.
It is. This penalty can be imposed on individuals, partners, officers, employees who are determined by the IRS to have been responsible for collecting, accounting for, or paying over certain taxes, primarily payroll taxes withheld from employees.
Like income tax, Social Security, Medicare withheld.
Exactly. Those taxes are reported on forms like 941, 943, 944. If someone responsible willfully fails to pay those withheld taxes over to the IRS, they can be held personally liable for the unpaid amount. The penalty equals the unpaid trust fund tax.
Wow. Personal liable.
Personally liable. This is a crucial compliance point because avoiding this penalty is effectively preventing significant lost funds and potential legal nightmares for the responsible individuals within the partnership. It's a stark reminder of the personal liability associated with certain tax responsibilities.
Good heads up. And finally,
Finally, for all items, meticulous record keeping is paramount. It sounds basic, but it's everything. Partnerships must maintain records supporting every income, deduction, or credit item reported.
How long?
Generally for at least 3 years from the return's due date or filing date, whichever is later. But for records pertaining to the basis in property, they must be kept even longer, essentially, for as long as they are needed to figure the basis of the original or replacement property. Thorough, organized record keeping is the absolute backbone of accurate tax reporting, and it's your first line of defense if the IRS ever asks questions.
That was a comprehensive look at what's on the core forms. Now let's turn to something that can feel very complex but is absolutely fundamental to a partner's financial health: their capital accounts and how liabilities are handled. This directly impacts how much loss a partner can claim, doesn't it?
Oh, absolutely.
Because if you can't deduct a loss, it's essentially lost money from a tax perspective that year.
Yes, this is an absolutely critical area for understanding your true financial picture as a partner. The analysis of partners' capital accounts is reported on Schedule M2 within the Form 1065 itself, and your individual ending capital account is shown on Schedule K1, Item L.
And how are those calculated?
Generally, partnerships are now required to report these capital accounts using the tax basis method. This account is basically a running tally. It increases with your contributions to the partnership and your share of partnership income and gains.
And decreases.
It decreases with distributions you receive, your share of partnership losses, and certain other items like depletion. It's important to understand that a partner's ending capital account can actually be negative.
Negative. How?
If losses and distributions have exceeded your contributions and share of income over time. It happens.
So the ending capital account is a good indicator, but you said it's not the whole story for a partner, right? I hear a lot about tax bases being different, and that's what truly determines how much loss you can actually deduct.
Exactly right. This is a key differentiator, and it's one of the most important concepts for partners to grasp, both for future gain loss calculations when you sell, and crucially for maximizing their deductible losses each year. Your ending capital count, reported on Schedule K1 Item L, does not necessarily equal your adjusted tax basis in your partnership interest.
Why not? What's the difference?
The big difference is liabilities. A partner's adjusted tax basis in their partnership interest includes their share of partnership liabilities. The capital account generally does not. Plus, basis includes other partner-specific adjustments.
And why is basis the magic number for losses?
Because your ability to deduct losses from the partnership is generally limited, first by your adjusted tax basis. If your share of losses exceeds your basis, those losses are suspended. You can't deduct them now.
Suspended, not lost forever.
Suspended, carried forward until you have more basis in a future year, perhaps from income allocations or additional contributions. Therefore, each partner is personally responsible for meticulously maintaining an accurate record of their own adjusted tax basis.
The partnership doesn't track my individual basis.
The partnership provides the information you need to calculate it and your share of income, loss, distributions, liabilities, but the ultimate tracking of your outside basis. That's on you, the partner. This separate tracking is absolutely vital. It's a core element of your personal tax planning.
Speaking of liabilities, how does the partnership track and report a partner's share of liabilities on Schedule K1? It's Item K, right? And what's the difference between recourse and non-recourse liabilities? Why does that matter for me?
Right, Item K on the K1. The partnership must report each partner's share of liabilities, clearly broken down into recourse liabilities and non-recourse liabilities. This distinction is fundamental because it directly impacts your tax basis and, importantly, your at-risk basis, which is another potential loss limitation rule.
Okay, recourse versus non-recourse. Define them.
Sure. Recourse liabilities are those debts for which a partner or a related person bears the economic risk of loss. In simpler terms, if the partnership can't pay, you might be personally on the hook for your share of that debt.
Like a personal guarantee.
Exactly. If you personally guarantee a partnership loan, that's generally recourse liability for you. Non-recourse liabilities, on the other hand, are debts where no partner or related person bears the economic risk of loss. Here, the lender can typically only look to specific partnership property like a building pledged as collateral for repayment, not the partner's personal assets.
So the property's at risk, not the partner personally.
Correct. Figuring out which bucket a debt falls into and how it affects your basis comes down to who truly bears the ultimate risk if the partnership defaults.
Are there any special rules for non-recourse debt, especially concerning real estate? Maybe something that still allows it to increase a partner's ability to deduct losses, even if they aren't personally liable?
Yes, there's an important and often beneficial nuance called qualified non-recourse financing.
Qualified non-recourse financing, okay?
This is a specific type of financing that, despite being non-recourse, is treated as an amount at risk for purposes of the at-risk limitation rules. This is particularly relevant for real property activities.
So it helps with the at-risk hurdle, even though it's non-recourse.
Exactly. To qualify, it must be borrowed for use in real property activities, and it generally must be loaned or guaranteed by a government entity or borrowed from a qualified person.
Who is a qualified person?
Generally, it includes commercial lenders like banks or savings and loans. It typically does not include related parties, the person who sold the property to the partnership, or someone who gets a fee related to the investment unless very specific conditions are met.
Why is this important for partners?
Understanding this detail is vital for partners in real estate ventures. It can significantly impact their at-risk basis and, consequently, their ability to deduct losses related to that real estate, even if they're not personally liable for the debt. This is a key area for tax efficiency in real estate partnerships, allowing basis and at-risk amounts from certain non-recourse debt.
So my ability to deduct losses isn't just about my contributions or even my tax basis sometimes. It's also limited by how much I have at risk. Does this mean I really can't just deduct all my losses if the partnership has a bad year?
Precisely. This brings us squarely to the at-risk limitations under Section 465. These rules are another crucial guardrail in tax law, often applied after the basis limitation. They generally limit the amount of loss and deductions a partner can claim from any partnership activity to the amount they are considered at risk in that specific activity.
And what counts as at risk?
Your at-risk amount fundamentally includes your cash contributions, the adjusted basis of property you've contributed, and your share of recourse liabilities for that activity. And as we just discussed, that special qualified non-recourse financing is also counted as an amount at risk for the activity it finances, despite its non-recourse nature. Regular non-recourse debt generally does not increase your at-risk amount.
So basis and at-risk can be different numbers.
They often are, yes. Your basis might be higher because it includes regular non-recourse debt, but your at-risk amount might be lower. Losses are limited to the lower of your basis or your at-risk amount, and also potentially by passive activity rules.
This is getting complicated.
It is. Understanding this is absolutely vital for partners to accurately determine their deductible losses each year. It's a significant aspect of tax planning for partnerships. If your share of losses exceeds your amount at risk for that activity, that excess loss is suspended.
Suspended again.
Suspended again under the at-risk rules this time. It's not lost forever, but you can't deduct it currently. It's carried forward to future years when you have more at-risk basis in that activity. This rule ensures your tax deductions don't exceed your actual economic investment or exposure to loss in that activity.
What if my partnership invests in another partnership, a lower tier one? How do those liabilities flow up?
Good question. If your partnership is itself a partner in other lower-tier partnerships, the liabilities from those lower-tier entities do flow through to your upper-tier partnership and then ultimately allocate out to its partners on the K1. The characterization of that liability, recourse or non-recourse, can even change as it moves up the chain based on guarantees or obligations at each level, so careful tracking and communication are needed.
Okay, we've covered the core forms: capital accounts, liabilities, basis, at risk. Now let's move into a fascinating area: critical elections and disclosures. These aren't just bureaucratic hurdles. They often represent key strategic decisions that can greatly influence tax outcomes, sometimes leading to significant tax savings, right?
You're absolutely right. These elections are often powerful strategic levers.
What kind of elections does the partnership itself make? The entity-level decisions.
Generally, the partnership decides how to calculate its income. For instance, it chooses the overall accounting method, cash or accrual. It selects the depreciation methods it will use for its assets, within IRS rules, of course. These choices directly affect the timing of income recognition and expense deductions, impacting cash flow and taxable income for everyone.
What are some specific key elections made at the partnership level?
Key partnership-level elections include this Section 179 election to expense property, which we talked about. That's a big one for accelerating deductions.
Right, the immediate write-off.
Exactly. Another specialized one is the Section 614 election regarding the definition of property for mines and oil and gas wells, which affects depletion calculations. These are decisions made by the partnership as a whole, impacting all partners' shares.
And a significant election related to compliance, especially for smaller partnerships, is electing out of the centralized partnership audit regime, isn't it? How does that work? Who benefits?
Yes, that's a very important strategic decision introduced a few years back. Under these rules, eligible partnerships can elect out of the centralized partnership audit regime, often called BBA for the Bipartisan Budget Act that created it, for a tax year. This election is a potential tax-saving and complexity-reducing move for smaller entities.
Who is eligible to elect out?
The conditions include having 100 or fewer partners during the year, and crucially, all of those partners must be what the IRS calls eligible partners.
Who are eligible partners?
Eligible partners are generally individuals, C corporations, S corporations, or estates of deceased partners. Partnerships with partners that are other partnerships, trusts, disregarded entities, or certain foreign entities are generally not eligible to elect out.
So simple ownership structures are key. Why would they want to elect out?
Making the selection can significantly impact future audit procedures. If you elect out, the IRS generally audits the partners directly regarding partnership items rather than auditing the partnership itself and having adjustments flow through complex BBA procedures, which can involve the partnership potentially paying imputed underpayments. For smaller, simpler partnerships, electing out can simplify the audit process, potentially reducing compliance costs and administrative burden. It's a key decision to discuss annually with your tax professional.
So the partnership makes some big operational and structural tax decisions, but then as individual partners, we also have choices on our own tax returns that can impact our personal tax bill, don't we?
Absolutely. While the partnership handles its operational elections, individual partners make certain elections separately on their personal tax returns. These are direct tax-saving opportunities for individual partners, allowing them to tailor certain tax treatments to their specific financial situation based on information provided on the K-1.
What are some examples of these partner-level elections?
Good examples include the Section 59E election. This allows a partner to choose to deduct certain qualified expenditures like intangible drilling costs from oil and gas or research and experimental costs ratably over a specific period, like 10 years.
Instead of deducting them all at once.
Right, or instead of capitalizing them if required. This can be a strategy to smooth out income and deductions, maybe manage AMT exposure. Another is the Section 108 election, related to income from the discharge of indebtedness or canceled debt. This is complex, but under specific circumstances like insolvency or bankruptcy, a taxpayer can elect to exclude canceled debt from income, often by reducing tax attributes like basis and assets. Also, the Section 617 election for deducting and recapturing certain mining exploration expenditures. These are all choices that reside at the individual partner level.
Which highlights the need for good info on the K-1.
Exactly. Transparent communication and detailed K-1 reporting are essential, so partners are aware of these opportunities and have the data to make informed elections.
This sounds like there's a lot of potential for missteps if you don't track things carefully. What happens if a partner contributes property to the partnership, say land or a building, but its current value is significantly different from its tax basis, maybe the original cost they paid for it years ago?
This is a prime example of where tax law steps in to ensure fairness among partners. Section 704C, allocation.
Section 704C, what does it do?
Imagine a partner contributes land they bought for $10,000, but it's now worth $100,000 when they put it into the partnership. That $90,000 difference is what we call built-in gain. Section 704C ensures that when that land is eventually sold by the partnership, that first $90,000 of taxable gain is allocated specifically back to the contributing partner.
Not spread out among all partners.
Correct. It's not spread pro rata. The same logic applies to built-in losses. They stick with the contributing partner. The partnership must use a reasonable method, the IRS provides several, to allocate income, gain, loss, and deductions from that specific property to account for that pre-contribution difference.
Why is this rule so important?
Without these rules, a partner could effectively shift their pre-contribution gains to other partners, or their pre-contribution losses to shelter other partners' income. Section 704C prevents this shifting and ensures tax consequences follow the economics. It's crucial for tax fairness among partners.
Are there any other complex scenarios involving contributed property, especially if a partner later receives distributions from the partnership?
Yes. Two other crucial rules, often called the mixing bowl rules, to be aware of. First, Section 704C1. If a partner contributes property with a built-in gain or loss, and the partnership distributes that same property to another partner within 7 years, the contributing partner generally has to recognize the remaining built-in gain or loss at that time. Second, recognition of pre-contribution gain on distributions under Section 737. This rule applies if a partner contributes appreciated property with built-in gain, and then within 7 years, that same partner receives a distribution of other property, not cash, from the partnership.
They get different property back out.
Right. If the value of the property they receive exceeds their outside basis in the partnership interest, they may have to recognize some or all of that original pre-contribution gain. These rules work together to prevent partners from effectively swapping properties tax-free through the partnership within that 7-year window. They're anti-abuse rules.
Wow, 7 years is a long time to track that. What happens when a partnership interest itself changes hands? Like I sell my interest to someone else, especially if the partnership holds certain types of assets that would normally generate ordinary income if sold directly.
Right. When a partner sells or exchanges a partnership interest and the partnership holds specific assets known as unrealized receivables or inventory items, special rules under Section 751 apply. These are often called hot assets.
Hot assets, why?
Because they can trigger ordinary income treatment even on the sale of a capital asset like a partnership interest. The selling partner first has to notify the partnership within 30 days. Unrealized receivables are basically rights to payment for services rendered or goods delivered that haven't been included in income yet, common for cash-basis partnerships, plus potential depreciation recapture. Inventory items include not just regular inventory, but essentially any property that isn't a capital asset or Section 1231 property.
So what happens with these hot assets on a sale?
The IRS treats the portion of the gain from the sale of the partnership interest that's attributable to these Section 751 hot assets as ordinary income, not capital gain.
Ouch. Higher tax rate usually.
Usually, yes. This is crucial for compliance and avoiding penalties. The logic is, if the partnership had sold these assets directly, it would have generated ordinary income anyway. Section 751 prevents taxpayers from converting that potential ordinary income into lower-taxed capital gains simply by selling their partnership interest instead.
Does the partnership have to report this?
Yes. The partnership is often required to file Form 8308, report of a sale or exchange of certain partnership interests, to inform the IRS and the partners involved about the Section 751 part of the transaction.
Okay. Finally, what are some other important disclosures and forms partnerships might need to file, particularly those dealing with international assets or maybe potentially aggressive tax positions, because these can carry serious penalties if overlooked, right?
Absolutely. Penalties in these areas can be severe. Partnerships can indeed have several other important disclosure requirements. For example, if a partnership holds specified foreign financial assets above certain thresholds, it may need to file Form 8938, Statement of Specified Foreign Financial Assets. This ensures transparency regarding foreign holdings for U.S. tax purposes, supporting FASE compliance.
Okay, foreign asset reporting. What about reportable transactions? That sounds like something the IRS pays very close attention to, a major area for risk management.
They absolutely do. Reportable transactions disclosed generally on Form 8886, but sometimes involving Forms 8275 or others, are a crucial area for risk management and avoiding significant penalties. These are transactions the IRS has identified as potentially being used for tax avoidance or ones that have characteristics they want to monitor closely.
What kinds of transactions are we talking about?
They include several categories. Listed transactions, which are specific tax avoidance schemes the IRS has officially blacklisted. Transactions offered under conditions of confidentiality regarding their tax treatment. Transactions with contractual protection against the disallowance of tax benefits like tax insurance. Transactions generating large losses above certain thresholds, $2 million in a year for partnerships, etc., and certain transactions involving significant book tax differences or brief asset holding periods.
So the purpose of these forms is just disclosure.
Primarily, yes. Disclosure. The purpose is to alert the IRS to these transactions. Failure to properly disclose a reportable transaction can lead to significant penalties, sometimes tens or hundreds of thousands of dollars, even if the underlying tax treatment of the transaction itself is ultimately deemed legitimate. It's a penalty purely for non-disclosure.
Wow.
So this is a critical area for ensuring compliance and demonstrating transparency. It's all about alerting the IRS to transactions they consider potentially problematic to avoid severe penalties down the line.
Okay. Now let's talk about something many business owners are excited about, and for good reason. The Qualified Business Income, or QBI, deduction, Section 199A. This is a huge potential tax break for pass-through businesses like partnerships. Can you break down what it is and how Form 1065 plays a role in partners actually getting this benefit?
Yes, the qualified business income, or QBI, deduction is indeed a significant potential tax-saving measure. It came out of the Tax Cuts and Jobs Act of 2017. It allows eligible individuals, trusts, and estates to deduct up to 20% of their qualified business income from a qualified trade or business.
Up to 20% deduction. That's substantial.
It can be very substantial. Since partnerships are pass-through entities, Form 1065 and Schedule K-1 are absolutely vital. They provide partners with the specific pieces of information they need to calculate this deduction on their personal tax returns. The partnership must separately identify key items for each partner on their K-1, usually using specific codes, often code Z in Box 20.
So what exactly does the partnership need to report for QBI purposes? What information flows through on that K-1 so the partner can calculate the deduction?
For QBI purposes, the partnership plays a critical role by reporting each partner's distributive share of several core elements. This includes your share of the qualified items of income, gain, deduction, and loss from each trade or business. These are the basic business operating results. Your share of the W-2 wages paid by that business.
Why wages?
Because, for higher income taxpayers, the QBI deduction can be limited based on either W-2 wages or the basis of qualified property, so that wage number is crucial. Also, your share of the unadjusted basis immediately after acquisition, UBIA, of qualified property. This is basically the original cost of certain depreciable, tangible property held by the business.
That's the other potential limitation factor.
Exactly, the UBIA of qualified property. The K-1 also reports any qualified publicly traded partnership PTP items and qualified REIT dividends, as those have their own separate QBI calculation components.
So the partnership does the initial sorting.
Yes, the partnership's role is to make an initial determination of what items are qualified at the partnership level for each trade or business, and meticulously report these amounts and associated wages UBIA to each partner on Schedule K-1. However, the final determination of whether an item is includable in your QBI and the actual calculation of the 20% deduction, subject to limitations, is ultimately done by you, the individual partner, on your personal tax return.
Factoring in my total income and everything else.
Correct. Taking into account your own overall taxable income and other tax situations, the K-1 essentially gives you the essential building blocks.
This deduction sounds fantastic, but I've heard there are some businesses that are either excluded or limited in claiming it. What are specified service trades or businesses, or SSTBs? How do they impact the QBI deduction?
Right. The specified service trades or businesses, or SSTBs, are a critical limitation to the QBI deduction. Generally, income from SSTBs is either limited or entirely excluded from the definition of a qualified trade or business for QBI purposes, especially once a partner's taxable income exceeds certain thresholds, around $190K for single, $380K for joint in 2024, indexed for inflation.
So if my business is an SSTB and my income is high, I might not get the deduction.
That's the general idea. If your taxable income is below the threshold, you can still get the QBI deduction even from an SSTB. But above the threshold, the deduction phases out and eventually disappears completely for SSTB income. This means if your partnership operates an SSTD, you might not be able to claim the full or any QBI deduction on that income if your personal income is high enough.
Can you give us some concrete examples? What kinds of services or businesses count as an SSTB? This is a really important distinction for many of our listeners.
Absolutely. SSTBs broadly include businesses providing services in specific fields where the value primarily comes from the skills of the individuals involved. The law lists these fields.
Doctors, dentists, nurses, therapists,
Lawyers, paralegals,
CPAs, EAs, bookkeepers, actuarial science,
actors, musicians,
providing advice and counsel,
athletes, coaches,
advisors, wealth managers,
stockbrokers, insurance agents, investing and investment management, trading securities or commodities.
That covers a lot of professional services.
It does. And there's also a catch-all category. Any trade or business where the principal asset is the reputation or skill of one or more of its employees or owners.
Reputation or skill. That sounds broad.
It is, but the IRS guidance narrowed it significantly. It primarily focuses on situations like receiving fees for endorsing products, licensing your image or likeness, or getting paid for appearances. It generally does not include many other businesses that rely on skill, like architects or engineers, unless they fall into one of the other listed categories.
So even if my business is an SSTB, the partnership still reports the QBI info.
Yes. Even if it's an SSTB, the partnership must still report the QBI-related information, income, wages, UBIA, but must clearly identify that business as an SSTB on a statement attached to each Schedule K-1. This is crucial, So partners can correctly apply the limitations on their personal returns based on their own income level, preventing a potentially costly error.
Okay, that's a really important distinction. What if a partnership has multiple businesses? Maybe a consulting firm, SSTB, and also a separate software development business, likely not an SSTB. Is there a way to combine them strategically for the QBI deduction?
Yes, and this is a major strategic move for potentially maximizing the QBI deduction for the non-SSTB activities. Partnerships with multiple trades or businesses can choose to aggregate them for QBI purposes, provided certain requirements are met.
Aggregate them. What's the benefit?
The significant tax-saving benefit of aggregation is that it allows the partnership, and thus the partners, to combine the W-2 wages and the UBIA of qualified property from multiple eligible activities. This can be absolutely crucial if one non-SSTB business, on its own, doesn't have enough W-2 wages or qualified property to maximize the QBI deduction for higher income partners.
But when combined with another non-SSTB.
Exactly. When aggregated with others, the combined wages and UBIA might be enough to overcome the limitations and allow for a larger QBI deduction on the combined qualified income. It's like bundling your eligible businesses to meet a higher qualifying bar for the wage UBIA limitation tests.
That sounds like a powerful way to unlock or increase the deduction. What are the specific requirements for aggregating these businesses? You can't just group anything together, right?
Correct. You can't just group anything. To aggregate multiple trades or businesses for QBI, all of the following strict requirements must be met.
The same person or group of persons must own 50% or more of each trade or business being aggregated for a majority of the tax year. And all aggregated businesses must use the same tax year end. This shows common control and reporting.
None of the trades or businesses being aggregated can be an SSTB. This is a hard rule. You cannot aggregate an SSTB with a non-SSTB to try and make the SSTB income qualified or borrow the SSTB's wages UBIA.
Okay, only non-STBs can be grouped. What else?
Number 3. The aggregated businesses must demonstrate they are part of a larger, integrated business by meeting at least 2 out of 3 specific economic factors.
They provide products, property, or services that are the same or are customarily offered together, like a bakery and a coffee shop.
They share significant facilities or significant centralized business elements, like common personnel, accounting, HR, IT.
They are operated in coordination with or reliance on one or more of the other businesses in the aggregated group. Interdependencies.
So there has to be a real economic link, not just common ownership.
Exactly. If a partnership chooses to aggregate, it must report this aggregation on a detailed statement attached to each Schedule K-1. This statement needs to clearly identify each separate trade or business included in the aggregation and explain precisely how the requirements, including the 2 out of 3 factors, are met.
And if they don't disclose it properly.
Failure to properly disclose the aggregation to the IRS can lead to it being disallowed upon examination. The IRS could force disaggregation, which might significantly reduce or eliminate the QBI deduction for some partners. So careful analysis and transparent reporting are absolutely key for leveraging this potentially valuable tax-saving strategy.
Wow, we've truly done a deep dive today. From the fundamental definitions of a partnership to sophisticated tax-saving strategies like Section 179, guaranteed payments for health insurance, navigating passive loss rules, and unlocking the QBI deduction. Before we wrap up, let's talk about the practicalities. Assembling this complex beast of a return, and then maybe zoom out for a broader look at the sheer weight of tax compliance. What's the right way to put together Form 1065 once all the schedules are completed? It sounds like there's a specific order the IRS wants.
Yeah, assembling the return correctly is the final crucial step in the filing process. And the IRS is quite particular about the order. It helps their processing. You start with pages 1 through 6 of Form 1065 itself. That's the main body.
Okay, pages 1 to 6 first.
Then come specific forms that summarize certain types of income or expenses, if applicable. Things like Schedule F for farming, Form 8825 for rental real estate, Schedule D for capital gains, Form 4797 for sales of business property, and so on. There's a list in the instructions.
Got it. Specific forms next.
After those specific forms, you attach all the Schedule K-1s, one for each partner. Following the K-1s, you add any other schedules in alphabetical order. Think Schedule L, balance sheet, M1, reconciliation, M2, capital accounts, and maybe the newer schedules K2 and K3 if there are foreign activities.
Alphabetical for other schedules, and then...
Finally, any other forms are attached in numerical order. It's like building a very precise sandwich, as you said earlier. Following the order helps the IRS process it efficiently. And a critical reminder from the instructions, Complete every applicable entry space on Form 21065 and Schedule K1.
No C attached in the boxes.
Exactly. You must not simply enter C attached instead of filling in the actual numbers on the form lines. Penalties can be assessed for incomplete returns. If you truly need more space for, say, an explanation or a list, you attach separate sheets, but always show the totals on the printed forms themselves. And make sure to include the partnership's name and EIN on every single supporting statement to avoid mix-ups.
It certainly sounds like a significant undertaking. All this complexity, the record-keeping, the forms, how much time and money does the IRS estimate it takes for businesses to comply with all these instructions and regulations? I imagine it's not insignificant.
It's absolutely a significant undertaking, and the IRS actually provides estimates of the average taxpayer burden as part of the Paperwork Reduction Act notice in the instructions. It's quite revealing. For partnerships filing Form 1065 and its related attachments, the average time burden for preparation is estimated to be about 60 hours.
60 hours? That's a week and a half of work.
For the average partnership, yes. And the estimated average out-of-pocket costs associated with that is $5,000. This covers everything from record keeping, learning about the law, preparing the forms, and submitting them, including potential fees paid to preparers.
Wow. And what about larger partnerships? Does it get worse?
Oh, yes. For large partnerships, which they define here as those having end-of-year assets greater than $10 million.
The same threshold for Schedule M3.
Right. That burden jumps significantly, reflecting the increased complexity. The average for large partnerships is estimated at a staggering 190 hours.
190 hours? That's almost 5 full work weeks.
It is, and an estimated average out-of-pocket cost of $28,200.
$28,000.
These are national averages, of course, based on IRS studies. They can vary greatly depending on the specific complexity, number of partners, type of business activities, quality of records, and so on. But it unequivocally underscores the sheer amount of work, expertise, and cost involved in partnership tax compliance. It really highlights the immense value of being well-informed yourself or engaging a skilled tax professional to navigate these waters effectively.
That's a really stark, quantifiable reminder of the complexity and the true cost of compliance for businesses. Any final thoughts for our listeners as they navigate their partnership tax obligations? Perhaps a forward-looking piece of advice.
My final thought is to always remember that tax laws are not static. They are constantly evolving. Congress passes new legislation, the IRS issues new guidance, courts make decisions, forms and instructions get updated.
It never stays the same for long.
Never. Changes can come out at any time, sometimes even impacting the current tax year after it's already started. So it's absolutely essential for partners and partnerships to stay vigilant. Always make it a practice to check irs.gov Form 165 for the latest information, any future developments, and legislative changes enacted after the instructions you might be looking at were initially published. Proactive engagement with tax updates is key.
Key to staying compliant.
Key to maintaining compliance, yes, but also key to leveraging new tax-saving opportunities as they arise, and certainly key to avoiding unexpected pitfalls from rule changes you didn't know about. The world of tax is never truly set it and forget it.
Wow, we've really done a deep dive today into Form 1065 and what it means for partnerships and their individual partners. From understanding the nuances of flow-through income to navigating tricky passive activity rules, basis limitations, at-risk rules, and even unlocking powerful deductions like the QBI, there's so much to grasp.
It really is.
And so many ways to be strategic, but also so many ways to trip up if you're not careful.
Indeed. What's truly fascinating here, I think, is that every piece of information on these forms tells a story about your business, and it has a direct quantifiable impact on your personal tax return. It's far more than just filling out boxes. It's about making informed decisions.
Decisions that lead to tax savings or better compliance.
Exactly. Decisions that can lead to significant tax efficiencies, robust compliance, and ultimately a healthier bottom line for both the business and its partners.
So what does this all mean for you, our listener? I think the sheer depth and precision required for partnership taxation really highlight that proactive engagement. Getting involved with your partnership's financials, understanding the tax planning, it isn't just good practice.
No, it's essential.
It's absolutely essential for navigating these complexities and ensuring you're leveraging every possible advantage the law allows.
Which leads me to a final question for you to ponder. Given this meticulous detail, the potential pitfalls, but also the strategic opportunities embedded within partnership taxation, how might a deeper understanding of these forms, like the ones we discussed today, How might that empower you?
Empower me how?
Empower you to collaborate even more effectively with your tax professional, to ask better questions, to understand their advice more deeply, to maybe transform what might feel like just a compliance burden into a true strategic asset for your business's future.
That's a powerful thought to leave you with, turning tax compliance into a strategic asset. Until next time, keep digging for those nuggets of knowledge.